Hey guys, what's up? I'm Erin and welcome back to the channel. Big news for retirees. A major new tax break just passed as part of one big beautiful bill. Starting in 2025, Americans aged 65 and older will be eligible for a brand new $6,000 deduction, and that number doubles to $12,000 for married couples where both spouses qualify. This isn't just a tweak to the standard deduction, meaning that it can help to lower your taxable income and it can help to reduce the amount of your Social Security subject to taxation. So in today's video, we'll break down how this new deduction works, who qualifies, the income phase-out rules, and 4 real-life examples to show you just how much you could save. Here's what the new deduction includes. If you're 65 or older, you'll now qualify for a deduction of $6,000 if filing single and $12,000 for married couples if both spouses are 65 or older. This isn't part of the standard deduction, it's in addition to it. Then you still get to take the standard deduction as well as the additional senior deduction that was already available. Lowering your adjusted gross income sort of has a ripple effect. It reduces how much of your Social Security could be subject to tax, it lowers your overall tax bill, and can make you eligible for income-based programs. So how big is the impact? Well, you'll see when I do 4 real-life examples coming up. In some cases, it might save seniors hundreds. In other cases, it could be thousands. And because of this new deduction, it really could be the difference between paying taxes on your Social Security benefits or not paying taxes at all. One very important thing to note, this deduction does not apply equally to everyone. There is a phase-out based on modified adjusted gross income. For single filers, they're entitled to the full benefit if the income is below $75,000, and it fully phases out at $175,000. For those married and filing jointly, they are entitled to the full benefit if their income is below $150,000, and it completely phases out if the income is $250,000. So if your income falls between those thresholds, you'll qualify for a partial deduction. But if it surpasses the upper threshold, you won't qualify at all. Those who stand to benefit most from this deduction are those middle-income seniors, those with an income of, say, $50,000 all the way up to, say, $150,000, and those who have a mix of different income sources in retirement, maybe Social Security, maybe a pension, maybe withdrawals from, say, their IRA or their 401k. And this is very, very important to note. This deduction right now is only temporary. It starts for the tax year 2025 and goes through 2028, unless Congress decides to renew it. This deduction is part of a broader promise to provide tax relief to older Americans. And while it doesn't technically eliminate taxes on Social Security, that is how it's being framed. Here's exactly what the Social Security Administration said in their official statement. The bill ensures that nearly 90% of Social Security beneficiaries will no longer pay federal income taxes on their benefits, providing meaningful and immediate relief to seniors who have spent a lifetime contributing to our nation's economy. And the Social Security Commissioner even added, by significantly reducing the tax burden on benefits, this legislation reaffirms President Trump's promise to protect Social Security and helps ensure that seniors can better enjoy the retirement they've earned. So even though the deduction isn't exactly the same thing as repealing taxes, for many seniors, the result can feel pretty close. A quick note about all of these examples before we dive in. To keep these examples simple and clean and focused, we are only going to be factoring in the new senior deduction, the traditional standard deduction, as well as the senior bonus. We are not going to factor in any other adjustments or credits or deductions that may apply. We are just going to focus on this new bonus and how it might impact things. Let's start with a very realistic scenario, a 67-year-old retiree filing as single with an income of $60,000 for 2025. So thanks to the new law, they now qualify for an additional $6,000 deduction, simply because they're 65 or older. So here's how the numbers would break down. Their previous adjusted gross income was $60,000. After the new senior deduction, their new adjusted gross income is $54,000. From there, we need to factor in the standard deduction for a single filer, as well as the already existing bonus that was available for seniors 65 and older. The standard deduction in 2025 is $15,750. The senior bonus for being 65 or older is $2,000 for an individual filer. So the total standard deduction for this individual is $17,750. Now we subtract that amount from the adjusted gross income. This gives us a total taxable income of $36,250. From here, we want to calculate their total federal tax for 2025. Keep in mind when you are calculating your taxes, not all of your income is taxed at the same rate. In the US, we use a marginal tax rate, so different levels of income are taxed at different rates. In this situation, our individual has a portion of their income taxed in the 10% bracket, and then their highest portion taxed in the 12% bracket. Their total federal income tax bill is about $4,100. All in all, this new deduction ultimately ended up lowering their federal tax bill by about $700 if we were to compare how much they would have owed under the old rules. So that is real money that is going to benefit middle-class Americans. Example number 2, let's say we have a married couple where one individual qualifies for the senior deduction and the other does not based on age. Let's say we have a married couple filing jointly in 2025. We'll say the husband is 67, so he qualifies for the bonus senior deduction. The wife is 62, so she doesn't, strictly based on her age. Their household income, $100,000. Let's see how this new deduction affects them and what their federal tax will be. Step 1, let's look at the total deductions this couple is eligible for. First and foremost, they're eligible for the standard deduction for those married and filing jointly. In 2025, that is $31,500. The husband only in this situation is eligible for the senior bonus that's part of the standard deduction because it is age-based. So in this situation, an additional $1,600. And again, for the new senior deduction, that $6,000 deduction, only the husband is eligible because, again, it is restricted by age, and he is the only one who is 65 or older. So in total, this couple is eligible for deductions of $39,100. An important reminder here is that these deductions are based on age. They're based on the age of 65 or older. They are not based on whether or not you are claiming or receiving Social Security. So you may have claimed Social Security at this point, or you may have delayed, but it wouldn't matter. The only thing they look at is the age, and you have to be 65 or older. From here, we want to calculate their total taxable income. So we take the total household income, $100,000, and first subtract the new senior deduction, that's $6,000. From this point, we want to subtract the standard deduction as well as the senior bonus. This will give us a total taxable income of $60,900. Then the next step is to apply the 2025 tax brackets for those married and filing jointly. This couple's highest marginal rate is 12%. So ultimately, their total tax bill comes to $6,844. Thanks to this new $6,000 senior deduction, this couple ended up saving about $720 on their federal tax bill than they otherwise would have had to pay under the old rules. So we can see here that they still experienced some relief even though only one spouse in this situation qualified. Really, the main point here is that this is relief for those middle income earning seniors. Next, let's do a married couple, both over the age of 65, but an income that falls in the phase-out range. We'll say we have a couple who's married and filing jointly with both individuals being age 67. So that means they both qualify for this new deduction since it's age-based. We'll also say they have a household income of $175,000. This is notable because this puts them within the phase-out range. So let's see how this phase-out impacts them. First and foremost, let's break down the deductions they'd be eligible for based on age and marital status. The base standard deduction for married couples filing jointly is $31,500. The senior bonus, that's the extra standard deduction for those age 65 and older. In this situation, both individuals qualify since they're both 65 or older, so that's another $3,200. And based on age, the new $6,000 deduction per person. But remember that this one phases out for higher earners. Think of it this way. A married couple would get the full $12,000 deduction if their income was below $150,000. It'd be gone completely at any income beyond $250,000. So we have a $100,000 phase-out range. The couple in our example has an income of $175,000. So $25,000 is in that phase-out threshold. Here's the math. $25,000 divided by a $100,000 phase-out range gives us 25% phased out. So instead of getting the full $12,000, they lose 25% of it. Ultimately, they lose $3,000 of the new deduction. That leaves them with $9,000 of the new senior deduction. So let's add up all the deductions that this couple qualifies for. The standard deduction of $31,500, the senior bonus $3,200, and then the new senior deduction after phase out $9,000. So the total deductions $43,700. This gives us a total taxable income for the couple of $131,300. And now we apply the federal tax brackets for 2025. For this couple, their highest marginal tax rate is 22%, and ultimately, their total federal tax bill would be just under $20,000. So this couple ultimately qualified for $9,000 of this new deduction, even though their income was in the phase-out range. And this is really important to focus on. You don't lose this deduction all at once. It tapers off gradually based on your income. And this is really important to keep in mind, especially for singles and couples who find themselves in this phase-out range. It isn't an all or nothing situation. Even a partial deduction reduces your taxable income and thus reduces your tax bill. For this example that we used, this couple found that the new deduction ended up reducing their tax bill by about $2,000 than they otherwise would have owed based on old tax rules. And let's walk through one last example, and this one's just as important. It's for those seniors with higher income levels because this new deduction phases out completely. For this couple, we'll assume that they're married filing jointly, both age 67, so age-wise, they qualify for the new standard deduction, but their household income is $300,000, and this puts them beyond the uppermost threshold of the phase-out range. So what deductions can they get? Well, since they're both over the age of 65, they do qualify for the senior bonus that's built into the standard deduction. Step 1, what deductions do they get? Since they're both older than 65, they still qualify for the senior bonus built into the standard deduction. So they get the standard deduction for those married and filing jointly, $31,500. The senior bonus here, which is $3,200. But as far as that new senior deduction, it's completely phased out for incomes beyond $250,000 for those married and filing jointly. Our next step is to calculate their total taxable income. In this situation, it's going to be $265,300. Then we apply the federal tax brackets. If we break their income down into chunks, the highest marginal rate they reach, 24%. And all in all, their total federal income tax bill would be just over $50,000. At this income level, they don't qualify for the additional $6,000 bonus deduction per person, even though they're the right age. They do qualify for the senior bonus within the standard deduction because that deduction is not based on income, and whether or not this couple is receiving Social Security doesn't matter. This is a perfect example of how this deduction phases out with income. And for high earners, it's completely eliminated. Here's the bottom line. This new $6,000 senior deduction is real, it's significant, and for middle-income retirees, it might be a game changer. For the first time in decades, retirees age 65 and older get a brand new deduction that they get to stack on top of the standard deduction, as well as the senior bonus that's built into the standard deduction. But remember, this deduction is tied to age, not Social Security. Whether you're claiming Social Security, whether you claimed early or you're delaying claiming, it doesn't matter. If you're 65, you're in. And while high-income earners may get phased out entirely, the fact of the matter is most retirees do fall in that middle income range, that $50,000 up to $150,000 as far as an income. And in our example, most retirees saw a tax savings of, say, $700, almost up to $2,000. Even partial deductions or when just one spouse qualifies makes a difference, and it helps to lower your overall tax bill. But remember, this is a temporary provision set to expire in 2028, so it's worth planning around while it's available. So are you or is someone in your household affected by this new deduction? Let me know your thoughts in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.